Okay, we're going to do budgeting, and we're going to take it from the sales budget onto the raw materials or the production budget, to the raw materials budget, to the direct labor budget, to the factory overhead, to the selling expense, to the general expenses, and then we're going to do a cash receipt and payment schedule, and finally a cash budget. Now that's going to set you up for doing the income statement, the balance or the retained earnings, and then the budgeted balance sheet. And the reason why we're doing a video is because I truly believe you're going to be getting all of this data put together for you, and then somebody is going, and you're going to say, or somebody's going to say, what does this look like for our financials next period? And that's where you're going to come together and create that budgeted income statement, the retained earnings, and the balance sheet. But before you get to there, you need to know how to do all of the others and where all this information comes from. So that's why we have this little sign here that says, please watch video. Uh, and it would be nice if it were spelled correctly, all right? For help with this assignment, because I'm going to show you how to do all the small budgets and then allow you to take that information and create the financial reports. So you'll have to fill this in as you go, because I think it's a good idea to get the mechanics of it down. But I'm not going to ask you to take off and do the whole thing by yourself. It's pretty extensive. So, and this will probably be done in, I don't know, 2 or 3 parts, because I don't like to let these run over 10 minutes. You tend to gloss over at that point. The very first thing you have to have is a sales budget. And that comes from gathering information. And here's your sales information. In March, we had 20,500. Now those are actual. In April, we're predicting 20,500. In May, 19,500. June, 20,000. And in July, 20,500. The selling price is $23.85 and the production cost is $19.85. And the year's total sales will be 240,000 units. So you've pretty well got that nailed down. So what does that mean? Well, first of all, I'm looking at the second quarter now. So for April, I'm going to take the budgeted units, multiply it times the budgeted price, and come up with the total budgeted dollars. You'll do that for each one of those and find out for the second quarter, you're going to have sales of $1,431,000 or predicted sales of that. So keep that in mind because that's going to be coming handy later on down the road. Now, after you get the sales budget, then you can look at the production budget. Okay, so what do we have to make? Now, this gets a little bit complex because you always want to consider it next month's sales into the mix of the budget, because you don't want to end the month with absolutely nothing in inventory. You always want to have something for the next month. So the first thing you do with this is you pull out next month's sales. Here's April, but next month, May, is 19,500, 20,000, and then 20,500. And the ratio they want to keep for production is 80%. So what they're saying is they want to have 80% of next month's budgeted sales also in the warehouse or ready to go into the budget. So they're saying our ending inventory when we get all done should be 15,600, 16,000, and 16,400. So that starts. Our budgeted sales are 20,000, 1950, and 20,000. So we are required to make how many units? Well, you add these two together to get the total units. You deduct the beginning units, remember? We have some that we begin with. So for this March's ending inventory was 16,400, so that's deducted. You do the same thing right here, 15,600 from here, and 16,000 from here. So this means the units to produce are 19,700, 19,900, and 20,400 for the second quarter. Okay, so now I have my production. I can go to my raw materials budget. Kind of see how this works. So now for the raw materials budget, there's some information. We want 50% of next month's material requirement left in inventory. March 31st remaining inventory was 49,025. June ending inventory was 4,000. These are things you're going to need to calculate. Raw material cost is $20 a unit, and raw material per unit is 1/2 or a half a pound, we're going to say. And then here are the purchases that we're going to look at. These you can use for check figure. So what does this look like? Okay, production units for April, and that comes directly from the budget, a production budget. We pop those in, and the materials per unit is a half a pound or a half a unit, whatever it is. So this is the amount we need for production. Now we also have to worry about that ending inventory that we want to have. Well, we want to have 49. We want to have the ending material. So how do we figure that as we look at this? Well, some of these numbers are given to us. So here's the March 31st ending inventory at 49.25. So we have that to begin with. This is going to be the inventory at the end of April, 49.75, and 51 is going to be the ending inventory for the beginning of June here. So now we're going to deduct those. So this is the material we have to purchase. And the price per unit, material price per unit, which is the material price, is $20. So this becomes our direct costs here. These are our total direct material costs. And I've put them over here and also giving you March because you're going to need March when you calculate out the cash disbursements. So you're always working backwards or forwards when it comes to inventory and production. Then we're going to do direct labor. Now everything gets really easy after this point. So direct labor, it says our production budget, from our production budget, we're going to make 19,700, 19,900, and 20,400. Labor per unit is a half of an hour. And labor needed for production, well, we just multiply these out now. So these are our labor hours. They get paid $15 an hour. These are going to be our labor costs right here. And here's your extraneous information to help you complete that. Most of this you lay out yourself. Even having a template, something like this, helps if you have to do all of this yourself. Now, factory overhead, guess what, is calculated on direct labor hours. So we take our direct labor hours from this, plug it into here, and the variable is 270, 2.7. So we multiply that out and come up with the variable overhead. And then we have fixed overhead to pop in, which is a given, and that is from depreciation. That's a fixed overhead that can't change. So that's 20,000. So now we have our budgeted total overhead. And then our next one is our selling expense, and we get that from a couple of places. First of all, we have our budgeted sales here from the very first one we did, the very first budget. We're going to pay 8%, so that gives us a commission expense multiplied out, and then we pay salaries of $3,000. That's the manager's salary that goes with the selling expense. So this gives us total selling expenses. Please remember this is very basic, so as not to get too confusing. So now we are now up to general expenses, and we have administrative salaries that are included in on this at $12,000. We have interest on a long-term note of $4,500 that's part of the general and an admin budget. Add those together, and we now have the admin. And we're going to stop here, and we have all of our smaller budgets put together, and now we're going to be able to do the cash receipts and the cash budget. So I'm going to stop this, and we'll start a new one.